If you've been trying to scale your real estate deals, but you keep hitting the same funding ceiling, this video is going to show you exactly why. It's not because you can't find good deals. You already know how to find good deals. It's because you're presenting those deals like a $200,000 operator would, while the people who can write $50 million checks evaluate opportunities in a completely different way. I'm Tarek Musa. I built a real estate and private equity firm from zero to over $1 billion in just 5 years. I've worked at BlackRock and JPMorgan. I've raised capital across nearly every type of deal, including real estate. And what I'm about to walk you through is the exact positioning shift that lets you move from small $200,000 deals to $50 million allocations. And here's the part that most people get wrong. You don't need a bigger tracker to make this shift. You need a different framework. So let's start with something that almost nobody explains clearly. Most operators think that scaling is linear. They think if I can raise $500,000, then I just need a bigger deal and more investors to raise $5 million. And then I'll just repeat that to get to $50 million eventually. But that's just not how capital works. Capital operates in tiers, and each tier has completely different rules. At the smallest level, capital raises between $200,000 to $2 million. You're usually dealing with friends, family, and local high net worth individuals. And these investors are investing in you. They're investing in trust, and they're investing in a relationship. You can explain a deal to them over dinner. You can text them updates, and the pitch is simple. Here's the property, here's the returns, and here's what I'm doing. And that approach works at that level. So now let's move into the next tier, which covers a $2 million to $20 million range. Now you're talking to regional family offices, small institutions, and just overall more sophisticated high net worth groups. And they're still evaluating you, but now they're also evaluating your operational capabilities. They want to see systems. They want reporting. They want to see a tracker that's presented professionally. And you can't just know real estate. You have to actually demonstrate process. Next, we move to the third tier, and this gets you into the $20 million, $30 million, $50 million or larger range. And now at this point, you're talking to institutional allocators, pension funds, large family offices. And here's the critical shift that you need to make. They do not care about your individual deal the way that your earlier investors did. Instead, they care about whether you are a platform that they can allocate capital to. I want you to notice the keyword that I use here, which is platform. Most operators, however, never internalize this. Instead, they try to use tier 1 language to raise tier 3 capital sources. They'll work hard and manage to land an institutional meeting, but then walk into that meeting and start talking about things like granite countertops and cap rates, and they end up getting rejected before the conversation even really begins. And to give you a real example, I want to tell you about a contact I have in the space who is growing and started raising money, and he and his team did a good job of actually raising a decent amount of money from smaller investors early on. And as they grew, they later tried to approach larger institutions using the exact same style presentations. And for nearly 2 years, they raised almost nothing. And they had the same level of intelligence, the same work ethic, and the same type of deals. But the positioning they were using was completely wrong for their new target investor. But once they eventually adjusted how they presented by shifting their angle from deal pitching to platform positioning, they raised about $120 million in under 15 months. That was the same person, but different framing. And that's how big this shift is. So now let's go deeper. When you're talking to a $50 million capital source, they are not analyzing your property the way you think they are. They are analyzing whether you are a reliable deployment vehicle for their capital mandate. And that is a completely different lens that they look through. You see, institutional investors, they have quarterly and annual deployment targets. So they don't just want one great deal. Instead, they need capital placed predictably and at scale. So when you walk in and say, I found an amazing apartment complex, you might think you're impressing them. But what they're thinking is something bigger. Like, can this person deploy $50 million within the next 12 to 18 months? And is there a repeatable acquisition process here? What happens after this deal actually closes? Is there a pipeline? And that's something they care about. Those are the real questions that they actually think about. And this is why you'll sometimes see a mediocre operator with a clear system get funded over a brilliant operator who has just one exceptional deal, because systems scale, while individual deals just simply don't. So if you're targeting bigger investors, then instead of saying something like, here's an amazing 200 unit value add opportunity, the positioning should shift to become something more like, we have a systematic acquisition strategy targeting value add multifamily in secondary markets with XYZ characteristics. And this is just the first of 8 projected acquisitions over the next 24 months. Do that, and now you're speaking their language. Now you're a deployment engine. And that's the mental shift from being an operator to being a platform. So the next thing I want to talk about is structure, because this is where most people accidentally disqualify themselves without even realizing it. You see, a lot of operators, they present deals like this. I need $5 million, you get 70% and I get 30%. And although this would not be at all unusual for tier 1 investors, that structure instantly signals to tier 3 investors that you don't understand how institutional capital actually thinks about risk. You see, institutional deals often have layers. There's senior debt, mezzanine debt, preferred equity, common equity, JV equity, and sometimes even more. And each layer has a different risk profile, and with that, also a different return expectation. And when you understand how to strategically architect a capital stack, you unlock a new scale. A $50 million deal does not actually require $50 million in equity. If it's structured properly, maybe you do a 70% loan to value on the senior debt, and that immediately covers $35 million from a lender. Then maybe there's $10 million in preferred equity with an 8% for return, which then leaves just $5 million in common equity that's left to raise. Now suddenly, you're not trying to raise $50 million, you're raising $15 million in total equity, and only $5 million of that is common equity that participates fully in the upside. Now, of course, I'm not saying to go out there and take a ton of leverage out on your deals. There is a balance between increasing returns through greater leverage and increasing operational risk through greater debt service. The key point I want you to take away is that knowing how to play with the different layers of a capital stack allows you to strategically pick and choose which of those layers you want to increase and which of those you want to decrease, so that you can get the deal done in a way that will make everyone happy. And being able to do that results in a completely different capital raise. And here's what's interesting about this. Institutional investors, they often prefer structured waterfalls where they receive a preferred return before you participate in the profits. And to some people, this is not so unusual, but to a lot of operators that are newer to raising capital, they think at first glance that by doing this, they are giving up way too much. While in reality, it makes capital easier to raise because you're now aligning with how institutions underwrite risk, and unsurprisingly, they want to minimize how much risk they take on. And when you understand capital stack architecture, you stop asking yourself, how do I find $50 million? And you instead start asking, how do I structure this so that the capital flows naturally? And that's how institutional operators think. Now, before we go further, let me say something directly. Most operators will watch this video, nod their head, and then present their next deal exactly the way they always have, because they think that it's too complicated to figure out how to do it the right way. But if you're serious about accessing institutional capital and breaking past that ceiling of a few $100,000, I'm doing free strategy calls this week where I'll show you how to unlock access to millions of dollars. If that's something that interests you, then click the link below and let's map out your exact positioning shift. Because the difference between where you are and where you want to be is rarely the deal, but more often than not is the framing to find and communicate correctly to the right type of investor. So we've covered a lot of information in this video, so let's bring this all together and review them. Institutional capital operates in tiers. Each tier evaluates you differently. At the highest level, they are evaluating systems, not individual deals. Capital stack architecture determines how much equity you actually need, and presentation sequence determines whether you're taken seriously at all. These core shifts are simple, but it's uncomfortable. But if you want to raise serious money, then you need to stop thinking like a deal finder and instead start thinking like a capital deployment platform. Most people realistically won't make that shift. They'll keep polishing spreadsheets, they'll keep tweaking IRRs, and they'll keep wondering why they can't break through. But the operators who internalize this framework, who reposition themselves as scalable platforms with structured capital stacks and disciplined presentations, those are the ones who start accessing allocations of $50 million or more consistently. But for everyone else, your deals are probably not the problem. More than likely, it's your approach and your positioning. And luckily, positioning is the easiest thing to fix once you understand what institutional capital is actually looking for. Now, let's talk about something that will either get you taken seriously or get you dismissed in under 60 seconds. And that is presentation sequence. The order you present information almost matters more than information itself. And here's what most green operators do. They start off by talking about the property, photos, location, renovation plans, cap rates, spreadsheets, and then eventually they talk about the team and the strategy. But that order is actually backwards for what institutional capital likes to see. You see, most institutions do a top-down evaluation for an investment. They first ask questions like, is this market worth allocating to? Is this strategy aligned with our macro view? Does this team have infrastructure? And only after that do they care about the individual asset. So the correct sequence generally looks something like this. First, you start with the market thesis and the macro opportunity, and then explain your systematic acquisition strategy, then your team and operational infrastructure, including your story, your track record, and your unique edge. And then you introduce a specific deal as a proof of concept. And finally, show your pipeline and scalability outlook into the future. You're not pitching a property here. Instead, you're presenting a machine, and this deal is just one output of that machine. There's also something that I call the 3-page rule. Your first interaction should not be a 100-slide deck. It should be a concise, controlled teaser, say 2 or 3 pages max, and it should highlight the market opportunity, your system, and your track record. That's it. If they're interested, then they'll ask you for a more deep dive, at which point you can share more information. But I've literally watched people work hard and finally get in front of a major institutions, pull out a massive deck, and start unloading every single detail they've ever prepared. And just like that, a few short minutes later, they're stopped mid-presentation and told that this is just not a fit, and they're walked out the door. And the problem wasn't that the deal was bad or they didn't agree with the thesis. It was simply that they ignored human psychology. You wouldn't go on a first date and immediately give someone a 2-hour autobiography of yourself, right? Capital raising works the same way. Being a great operator is a science, but presenting effectively is an art. And without the art, the science itself never gets funded. So with that, congratulations. You now understand why capital sources of $50 million or larger evaluate opportunities completely differently than the investors that you've been talking to. If you want me to personally walk you through how to reposition your deals for institutional capital and build a system that consistently gets funded, book a free strategy call below, and I'll show you exactly how to apply this framework and customize it to your specific situation. And if you want to go deeper on the institutional approach to raising capital, then watch this next video, how to raise capital for real estate the right way, because that's where we break down the institutional mindset that makes everything we just covered actually work.